for RealComp's town hall meeting. Tonight we have some great information to share with you. We're going to talk all about mortgage forbearance, and we have two experts who are going to give you a presentation, and then we're going to answer as many questions as possible. With this many people, it might be difficult to answer all your questions, but we're going to do the best we can. So first, I want to introduce you to both of our speakers. First, we have Danielle Boote. Danielle has been in the mortgage industry in Southeast Michigan for 31 years. Currently, she is the branch manager and senior loan officer at Highlands Residential Mortgage in Brighton. Danielle has been actively involved in the local real estate community her entire career, from serving on association committees to also being an active member of the Women's Council of Realtors. She has been awarded Affiliate of the Year for WCR Livingston Chapter in 2011 and 2018, President's Club qualifier annually for the past 10 years, and recently earned her Certified Mortgage Advisor designation. Her passion for the real estate industry was sparked early in her career when she realized it was not hard to buy a home if you just knew the steps to the process. She loves teaching clients what is necessary to begin to realize the American dream of becoming a homeowner. Danielle and her husband, Jim, have lived in Livingston County for the past 27 years. They have 4 children and 2 grandchildren and 2 dogs. Don't forget the dogs. Her favorite pastime is boating and being on the water. Welcome, Danielle. Next, we have Victor Bals. Victor has been originating residential mortgages for 20 years in Livingston County. Prior to the mortgage industry, Vic lived and worked overseas in Japan for 3 years as a program manager for a major auto company. Vic's wife, Maya, I hope I'm saying that correctly, who he met in Japan while singing in a band, also shared the love of music. Their first date was utilizing a dictionary as both only shared the language of music. When Vic and Maya returned to America, they wrote, recorded, and have copyrights to 35 songs and sold 3 to record companies. That's awesome. The day their daughter was born, they gave up music to be parents. But I bet you still sing to her. Being new parents and broke, they needed to buy a new home. So Vic looked in the phone book, saw the Rural Development Zero Down Mortgage. At the closing table, the loan officer said to Vic, "You really get the numbers and you'd be really good in the mortgage industry." A couple of weeks later, Vic quit his job as an engineer, gave up a salary, benefits, and a pension for 100% commission. Vic changed careers from engineering to the mortgage industry at the request of his wife. Maya wanted her husband home with the family and not traveling the world. The mortgage industry gave Vic the flexibility to create his own destiny and build his business around his family. In 24 years of marriage, having 3 children on 7 different travel soccer teams at one time, he has never missed a soccer game, a doctor's appointment, or a school event. He has a passion for the industry, the people, and problem solving. The engineering background has been key in a successful career in the mortgage business for Victor. We thank both of you for giving us your time tonight, and I'm going to turn it over to you. But before we do that, I want to just let all of the people who are watching know, if you have questions, as we've done in the past, please type them at the bottom where you see the Q&A. Please type your questions in there. When Victor and Danielle are done with their presentation, we'll go through those questions. Please try to keep your questions associated to the presentation. I know right now there's a lot going on in our world, and you probably got questions about other things. And I never like to tell you you can't answer, but if you could please first keep all your questions focused on the presentation. And then if we have a little bit of time at the end and you want to ask me other questions, I'll answer whatever questions you have. So Victor and Danielle, take it away.
Good evening. Thank you, Karen. You want to pull up the PowerPoint?
Yep. Thanks a lot, everybody. We're happy to be here tonight. Go ahead, Danielle.
So Vic and I created this presentation over the past several months because we had a lot of questions from real estate agents on what exactly the forbearance program was that came out last April as part of the CARES Act passed with the first COVID relief package by President Trump. And it's kind of evolved over the past 10 or 11 months. So we're going to give you a snapshot this evening of what the most current data that we have on forbearance, how it works. And what's really important as a real estate agent, we feel that you understand right now, is how this could impact you and your clients in this spring market. We're going to talk about what is mortgage forbearance and how it affects a borrower, what the current required borrower documentation is if forbearance was used on their current mortgage, and what is a borrower's eligibility based on their current mortgage forbearance status. We may very well have people that are thinking about selling a home this year and are going to be potentially impacted unknowingly by the fact that they may have taken a forbearance. One of the things that really surprised us in the mortgage industry over the last, let's say, 9 months, even with clients that are refinancing or thinking about getting pre-approved, is that if a homeowner contacted their mortgage servicing department and asked a question about forbearance, frequently the mortgage servicing company literally clicked a box in the computer on their end and put them into the forbearance program. The borrower may have been making house payments the entire time, and they were a bit surprised when we pulled their credit to find out that they were labeled as being in forbearance.
And many times even the client didn't call their servicer, and some of the servicers just automatically put everybody in forbearance. If they made a payment, great. If they didn't, it just wasn't marked on their credit report. So we've had numerous times where we had to get a verification of a mortgage and the client didn't even know they were put in forbearance automatically.
We have seen it on some credit reports, a designation that they were in a natural disaster. So on a federal basis, this whole COVID situation really declared the entire country a natural disaster. It's obviously not a flood or an earthquake like we might think, but again, this could cause, and we'll go into this in more detail, a potential borrower from having to worry about something on their credit that they didn't think was even an issue.
You know, so let's just talk about the whole forbearance thing. How did it come about? So Danielle, just speak, tell them about the CARES Act and when did this start? And Karen, I want to know, can you see this screen right here that I'm showing?
Yes. Yes, I believe
Okay.
everybody can.
So anyway, let's just talk about the CARES Act. And I'm going to bring this back to basically January of 2019 here. Now, what you guys are all seeing here, these are mortgage-backed securities, and this is what interest rates follow. So now, as the rates as you see these numbers get towards the top of the screen, rates are getting better. And as they come down towards the bottom of the screen, rates are getting worse or they're getting higher. So as we move back to December of 2019, we were just starting to hear about a little bit of COVID over in China and all that stuff. Then as we follow the calendar along here, and we're in February, we knew COVID was hitting here. And right here is when they basically shut the government down. Right there about March 9th is when they shut the government down. And what had happened is they shut the government down and all of a sudden they lowered interest rates dramatically. So at that moment, on this day, on March 9th, rates bottom out and they were at about 2.75 at the time there. About 27 million Americans called their loan officer or called their bank and said, I want to refinance and I want to lock in the interest rates. So all the mortgage companies across the country were just inundated with all these people who wouldn't lock in. The mortgage companies just couldn't handle the volume at all. So they said, shut the doors. We can't handle the volume.
So just to clarify, what occurred in early or the mid-March was that the government changed the bank lending rate to 0. That is basically the rate in which the federal government lends overnight lending, very short-term lending to the banks at 0. As soon as that got on the market, literally our phone started blowing up. I think that was about March 17th.
Yep. And so what happened, rates bottom out, everybody tries to lock in, the lenders can't handle the volume and they raise rates overnight within a 3 to 4 day period. we've seen interest rates go to about 5% just because the mortgage companies couldn't handle the volume. They had to hire more people, blah, blah, blah. And then back here around April 1st is when the CARES Act comes in. And if you look at these little red things and green things, this is the volatility in the market in a one-day period. So this market was very volatile as the CARES Act come in. And then the CARES Act said, hey, everybody, you don't have to make your rent payment. You don't have to make your mortgage payment. Oh, and you don't have to make your student loan payments. We're in a natural disaster. So that's when people started going into forbearance and stopped making their payments, or ones who didn't even need to, that were they were totally employed, said, well, hey, the government says I don't have to make my payment. I'm not going to. So the CARES Act started there, and then interest rates started moving here. Okay. And then what happens is during this period here between April and about August, everybody was on board doing all their refinances. And now this is when the forbearance starts to affect the lenders, because if you, the consumer, stop making your payments, that doesn't stop us, the servicers. By law, we have to make that payment for you, okay? Because you don't make your payment, I have to make the payment plus the taxes and insurance to the ultimate investor, Fannie Mae, into the mortgage-backed securities. And where are all these mortgage-backed securities? These are all the stock portfolios you have in your own 401k. And they're not going to let us stop making that payment by law, else we're going to hit a 2008 situation again where we all lost 40% on our 401ks. So at this point, the servicers are eating all their cash reserves, making all these payments for these millions of people in forbearance. And what happens is we're losing our cash reserve. So right here, and I'm going to fast forward here a little bit, and let's come up to here, right here on August 11th, government comes in, or Fannie Mae comes in and says, you know what? We are taking such a beating from the service industry, from all these people who are having forbearance. Our cash reserves are down. We're going to impose a 0.5 point, meaning a $1,500 charge on a $300,000 loan, or about 1/8% to 1/4% bump in interest rate to cover the losses for the servicer. So ultimately, the consumer always pays. So the Mortgage Bankers Association went to Washington and says, hey, you can't just raise the rates on everybody. We have everybody floating on interest rates and just overnight with no warning. So the feds back off a little bit and they said, okay, we're going to lay off this for now, but we're going to impose this come December 1st of 2020. So the market started to relax, rates started to get better, up and down, rates started to get better, rates started to get better, and they kind of bottomed out here in December 1st, and then they kind of bottomed out here again on January 4th. Then we have a little volatility in the market, and now what's happening is we have the scare of inflation here, because a lot of the consumer, the government agencies, or economists think that, oh my God, COVID's over, we got the vaccine, everybody's going to be back to work. That's going to drive up inflation. So now what we're doing is in the last few days, we see the market just going nuts. We went from a 2.75% interest rate right in this area up to today to 3.25% on the scare of inflation. So that's the effect that the forbearance had on that market. We believe this is going to be short-lived, and we're going to start to see a return to lower rates once we see that we are not out of the woods on this. So as we go back to the forbearance screen here, so now we're going to go into this and give you a little bit more detail. Is there any questions we can answer at this point, Karen?
Well, there are some, but I'm not sure that they're directly related to that. So if you don't mind, we'll go through the presentation.
Okay.
And then if you have to bring slides back up to
Okay.
reference some of the questions, it just seems to work better that way, Victor.
Okay, very good. So
Okay.
Danielle's going to cover from a lending standpoint. We're actually going to bring up the credit report here. So Danielle's going to take over and start talking about this.
Can you see the credit report, Karen,
Ye-
just to confirm?
yes.
Okay.
Yes.
So what we're going to show you on the next couple of slides are actual copies of clients' credit reports that we have run into the last couple months. We want to share with you how challenging this is for a lender to view, and so that you can kind of get a picture of why this is so challenging. So when we look at a credit report, one of the first things that we're going to look at is the date last reported. Yep, right there. Vic's going to highlight some of these areas to help you follow along. This date is the date that the information that we're looking at is current to. We also want to go look at the borrower's scheduled payment. This section here shows 0. Normally, we would see a payment here. The other thing that is important down below are the bureau remarks, which show that Experian and TransUnion are showing the payments deferred. This is where one of the issues is every mortgage company shares this information differently. It can show payment deferred, it can show natural disaster, it could show forbearance, or it could just show that they're in current repayment. And this will tell us it's a Freddie Mac mortgage. You can also see that there's no current late payments over here in this section. So when someone is in forbearance, they will not have any late payments on their current mortgage account. Okay, this page is showing you something called trended credit data. This is on the back end of a credit report, and it allows a lender to dive deeply into exactly what payments the borrower is currently making on their mortgage. So in this particular situation, we can see back 12 months. We can see that they were making what their minimum payment is. We can see what their actual payment was in this line here. And then we can see when the forbearance started that the last payment this client made was in July of 2020. And they, at this point, had missed 6 payments. Here's an example of another client, a little bit more challenging in this situation. We have no past due payments showing. Of course, we have no late payments showing. And then when we look down at the bureau remarks, nothing out of the ordinary here. Account is open, paid as agreed, and it shows that it's just a conventional real estate mortgage. So let's look at the next page that goes along with this mortgage, and we'll see how we uncovered a little bit of a challenge. So if we look at the actual payments on this loan, this didn't make any sense to us when we first looked at it, right? Their payment is $1,347. We can see that they were making payments February, March. Something was missing in January of 2020, which is before the forbearance. But you can see in April, which is when the CARES Act was enabled, is when they stopped making their payments. Then we could see that they were making partial payments in May, June, July, and August. So in this situation, it would have been very easy for a loan officer to miss that they were in forbearance. And what actually was occurring with this particular client is that this mortgage company, through a credit union, was allowing the borrower to pay interest-only payments during this time. We've seen a lot of clients in forbearance, and this is the only client that I had seen with this type of situation. Okay. Per agency guidelines, the lender must apply due diligence for each mortgage loan on which the borrower is obligated to determine if any mortgage payments were skipped. This is the job of the loan officer, the mortgage processor, and the underwriter. So this is the statement that the government has made on all agency guidelines. It's up to us as a lender to determine if this client has been up to date on their mortgage. So this would apply if they were refinancing or potentially purchasing a home.
Okay, and as we talk about this here, the CARES Act does not allow servicers to report loans previously in forbearance or skip payments. So this is why it's not going to affect their credit scores. By law, they can't do it. The lender must document the payment history on each mortgage loan to determine if payments were skipped. And these are where the lenders are going to ask for a 12-month history or a printout to show or have the client prove they've made payments. And we're going to talk about this a little deeper for you agents who are going to list a home and some of the diligence or questions you're going to want to ask that seller, because this could affect the sale of that home, and you do not want to leave your sellers homeless, which we've seen in a couple cases where it got very dangerous here.
Now, if we, in talking about how a lender reports to the credit bureaus, typically when we pull a report, the data we're going to be receiving is anywhere from 4 to 8 weeks behind, depending on when we pull the report and when a creditor reports to the bureaus. They're only going to report to the bureau once a month. So the challenging thing when we have a client in process trying to close on any loan is that we may have data on the credit report, but then we're going to have to fill that gap to make sure that we have the complete picture. We have many clients that have more than one mortgage, more than one property, and we're going to have to document this for every property that they own.
Well, and Danielle makes a great point, because if you look here, we got to document every mortgage the borrower is obligated. And I learned this the hard way with one of my clients. As we were doing a transaction, and he said back in August, hey, I went in forbearance. And I said, man, you got to get out of forbearance. We're not going to be able to do a loan for you. And so we started processing the loan, and I failed to mention to him that, hey, both your rental homes in Florida got to be out of forbearance too. So that put a stall tactic on there for 3 months. And so I had to watch what I say, and I learned the hard way. It's for all properties, second home, rental properties, anything you got a partnership with, it's all properties. So when you're talking to your sellers, potentially, are you in forbearance on your mortgage? If they say no, go, do you own any other real estate that you potentially have forbearance on? You're going to definitely want to address that question.
The portion of homeowners postponing mortgage payments has been falling steadily from June to November. So that's good news. It's an indication that people are returning to work and the economy is beginning to recover. But the decrease has largely flattened since November, when the current wave of coronavirus cases surged again in communities across the country. Now, the data, when we put this together, it was in the end of January, so that's about 30 days old. The good news is nationwide, the vaccines are increasing, which is good news to hopefully protect everyone, and coronavirus cases are also still dropping.
Okay, for roughly the past 2 months, that group of homeowners has flatlined at about 5.5%, according to the Mortgage Bankers Association. Though that is down from a peak of 8.55% in June, some economists are concerned about the stalling forbearance rate and worry that it could even start climbing if the economy further sheds jobs. Because right now, we're in forbearance because of a national disaster, but now we're going to have the fallout from the national disaster because a lot of people are laid off or those jobs are eliminated. So we may have a surge of some type of stimulus to let these people go into forbearance for even longer period of time until they can actually recover or create those types of jobs. And as we go on to the graph right here, now, if we look at this blue line right here, this is the total mortgages here. We peaked at about 4.5 million mortgages here, and then it's kind of steadying out to about 3 million across the country. And this breaks it down where the green line is your conventional loans, the blue line is your FHA government loans, and the gray line is all the others. That's the jumbo loans and rural development and such like that. So yes, we are seeing them kind of be steady, but when we look at 5.5%, 6%, that means, in Livingston County, I think there's about 100 listings out there right now for single family dwellings, minus any condominiums there. That means probably 5 to 6 of those are in forbearance. So this could cause an issue.
Now, one of the things, for those of us in the mortgage business, when the whole forbearance idea came out last April, we all looked at each other and said, well, this isn't good, because we knew that mortgage guidelines would change, and we didn't see mortgage guidelines start to change until June. So we had a kind of a short window of time where, let's call it no man's land for mortgage guidelines. And we knew, and ever since June, the mortgage guidelines have been slowly evolving to where they are today. The thing with forbearance is that, and we're going to go into the different structures of that here in just a moment, but consumers do not look at forbearance as a bad thing, okay? They don't look at it in most cases that they are potentially on the road to a foreclosure, okay? I had a client back in July, absolute true story here. Past client, wealthy individual. I was doing a refinance on their second home in Florida. They bought it a year ago for over $800,000. All we were trying to do, shorten their mortgage term, lower their interest rate. They are self-employed, high income, high net worth. We were into the mortgage process for several weeks. We are literally ready to go to underwriting to clear the loan, and we get a flag when we pull the final credit report just prior to closing that the mortgage in Florida is in forbearance. So we called the client and said, what's going on? Did you do something with your mortgage, or is this an accident? The wife told us, who was our main contact, oh my gosh, I didn't think that that was going to be a problem. I figured I'd save the payment because we were getting ready to close on the refinance. She literally said, please don't tell my husband, he's going to kill me, because she didn't realize she was making a dangerous financial mistake.
And she was just doing, it's cool. Everybody said I can skip a payment. It must be okay with the lenders too.
Mm-hmm.
That's where the government's making these guidelines, not talking to the lenders saying, wait a minute, this could cause a big problem. So as we start moving on here a little bit further, go ahead, Daniel, talk about the docs.
In the end of August, one of the guidelines that changed was that we required, and this is all lenders nationwide, not just our company, it is required that we get the verification of mortgage with the 2020 transaction history for every mortgage that the borrower is obligated on. And we have to prove that they made 12 mortgage payments with nothing being skipped.
And what happened here is we've got a lot of rock solid buyers here. I mean, they're 20% down buyers, never missed nothing in their life. And they are just accusing us of throwing them under the bus. And I said, we're not discriminating against you. We throw everybody under the bus right now. And what we don't like, it's causing a strain on the lender client and the client realtor relationship, because a lot of our business comes from realtor referrals. They're going, oh my God, that lender you stuck me with, they're just throwing me under the bus for all this documentation. I don't need this. And it makes a bad experience. So it's about the agent setting expectations up front, and also the lender setting expectations up front, because trust me, we don't want to ask that customer for any more than we possibly need here.
Yeah.
Going on to the next slide here. Go ahead.
Okay. In addition to verifying, if a client has gone into forbearance, we also have to document the forbearance itself, including a reinstatement or a loss mitigation agreement. So let's talk about that in a little detail. When a client calls their mortgage servicer and says, I lost my job, or I'm laid off because of COVID, I need to take the forbearance. And I guess let's put an asterisk on that, because you don't even have to have a reason to take the forbearance. Certainly if someone is in financial distress, the whole purpose of forbearance is to protect them, to protect their credit, to protect their home. But there's a lot of people that took it or didn't take it because of what the lender did for no reason at all. They had no income, interruption or anything of that nature. The original purpose of the forbearance was allowing a borrower to skip all payments and then to bring the loan current within a short window of time. So the original reinstatement idea was to give them 3 months of missed payments, and then in the 4th month, they would make all 3 missed payments plus the current payment. So as an example, if your payment's $1,000 a month, in that 4th month, you're going to owe $4,000.
And now here's the concern, because one, there's a lot of people who didn't need to take advantage of forbearance. They just did it because they could. They didn't have to make them. But the real people that actually needed the help, if they can't make 3 payments, how in the heck are they going to make a $4,000 4 payments and make it up? And under the original rules of the forbearance, that on that 4th month, if you did not make up all those payments, the banks were going to start the foreclosure process. And that was a little concerning there too, because these people are sitting on so much equity now, chances are they wouldn't let it go to foreclosure. They would just maybe put it on the market and sell it for a lower price. And of course, we need the inventory, but that could have an impact on sales price if forbearance got too high and the lenders did start to foreclose. So as the lender started to make this up as we went along, seeing the impact of that, they said, look, okay, maybe we don't make them catch up, but what we'll do is we'll let it go to loss mitigation. Why don't you explain that, Danielle?
So loss mitigation is a situation where the borrower has deferred payments, but there's no way that they in the 3rd, 4th, 5th month could make up that lump of payments. So what the borrower agrees to at this point is a loss mitigation agreement with the lender that will defer any payments to the end of the loan, or they will enter into a repayment plan to come up with a solution to bring the loan current. In either of these situations, as long as the borrower had all their previous mortgage payments on time prior to April of 2020, there would not be a mortgage payment late on their credit report. But here's the kicker. If you had a borrower that was in financial distress before the CARES Act and was late on a payment, maybe in the 1st quarter of 2020, none of this applies. So they would continue to have late payments on their mortgage.
Okay, so now as we found out how we got into this mess here and the rules that tried to change as we're making up as we go along, the lenders seem to conclude it says, okay, we got to give people mortgages. So how do we treat this under each particular loan? So to be eligible for a conventional loan to refinance or purchase, lenders have to, mortgages must be current with no skip payments. Mortgages must be brought current by reinstatement prior to a clear to close. And we got to document 3 months after loss mitigation date prior to clear to close. Danielle, you want to explain that 3-month payment after loss mitigation?
Yes. So with the credit report examples that we showed a few slides at the beginning of the presentation, all of these borrowers, we basically had to put their refinance on hold until they then made 3 payments on time. They had to show that they were no longer in financial distress. They were able to make their current monthly mortgage payment. And then once we document that, we can get it clear to close. Now, one thing I'd like to add here is that as we're going through these slides about mortgage guidelines, we are giving you actual agency guidelines from Fannie Mae, Freddie Mac, FHA, VA, and rural development, and we will talk a little bit about jumbo. Keep in mind that lenders can have overlays. I'm sure you've heard of that before. Our company does not have overlays, and we are giving you actual data. So you may find local lenders that have slightly different requirements. Those could be because their company is not comfortable with the risk here and has put additional overlays on their underwriting.
And remember, Fannie Mae guidelines, these are the minimum guidelines. A lender overlay is going to make it much more tough, or tougher in some sense of the way, but this is as easy as it's going to get.
Mm-hmm.
Now, as we move on a little bit, this is where it gets interesting, and especially for you real estate agents here, that if you are in a conventional loan and you had forbearance, the only exception is a departing residence may be in forbearance if it is sold and closed a minimum 1 day prior to closing on the new owner-occupied purchase, okay? So if you do have a seller on a conventional loan who is in forbearance or loss mitigation, you have to close on that loan. They have to make the lender whole, and then you can close, and that has to be on the closing disclosure on the sale of that home. Then you can close the next day on the new purchase of a primary residence. So there cannot be no simultaneous closings. It has to be at least 24 hours after the closing of their current residence.
Now, here's something to consider in this exception. You might say, how would this make sense? Why would somebody be in financial distress, need to be in forbearance? Maybe somebody lost their job, has now gotten a new job, and is selling a house to move to a different area to be closer to their new job. That might make logical sense. And keep in mind, an underwriter is going to look at that to say, okay, does this make sense on why somebody would be in forbearance, can sell their home and purchase a new home? Maybe somebody would be downsizing.
Yeah, or maybe a couple, one of them lost their job and they do want to downsize, and one of them still has a job and they can't afford the current home. So that might be a great exit strategy for them. They just need to understand the rules. And what you're going to need to do is make sure that your customer talks to their lender to make sure that their lender has no overlays, and you're going to have a green light prior to closing, before you get it listed, before you take it under sales contract. Do your homework, because if we don't meet these guidelines, you could leave a potential seller homeless, like in the next example on some other type of mortgages.
That's what we're trying to avoid. But you cannot do a back-to-back closing with the sale of their home. Again, it has to have at least 1 day of, difference. You close their current home on a Monday, we can close their new home on a Tuesday. Keep in mind one other thing though. When you're doing a seller net sheet, if your client is in forbearance, they may have a higher payoff than you thought in the first place because their escrow account probably went negative. If they've been down on 3 to 6 months worth of payments, they're going to have to catch up the escrow account. Plus, yes, interest is being charged on whatever they're not paying. So you could have a situation, maybe someone bought a house just a year or two ago that may be a first-time home buyer. They didn't put a lot of money down in the first place. We feel that this is probably the biggest segment of the market that could be at risk for having a little bit of a struggle selling a home. Yes, their house has gone up in value, but if they bought for 3.5% down FHA or were a MISHDA loan, they're not going to have enough equity potentially in the house to cover the real estate fees. And if you couple that with a payoff that's going to be a little bit stressed because of interest, escrow, you could end up with a payoff that was higher than what showed up on a pre-title commitment or what the client tells you they think they owe on their house.
Right. And that could be a big bombshell coming in, right at there at the end when you get that payoff and it's $5,000-$6,000 higher and they were walking out with nothing. If they don't have the cash to close, that deal is dead.
Yep.
Again,
this is what we wanted to share with you as a real estate agent, why this is so important.
Okay, so that's conventional financing. So just to recap there, yes, if your seller is on a conventional loan and they are departing that residence for a new primary residence, they can close, but it will be the next following business day after the original lender is made whole. Okay. Next slide. Let's talk about FHA. This is pretty straightforward and it's going to hurt. Okay. If your seller is in an FHA mortgage and he wants to go to a conventional mortgage when he sells and he buys a new home, it'll be fine because he's going to make his current lender whole at the time of closing when he departs that home. But if we have an existing FHA seller who plans on utilizing FHA financing in the future, he will not get a mortgage because he has to document 12 monthly payments after reinstatement or loss mitigation. And chances are he's going to have to rent for 12 months to show a rent history that he's able to make payments. So if you have an FHA seller, he is either going to have to go into conventional or rural development, which we're going to cover here. So FHA is pretty straightforward. You won't be going FHA to FHA if your seller is in current forbearance. Okay. Next one is the rural development. Danielle?
Okay. Rural development. Now I know as far as all of you agents on this call, you're all over the Detroit area. So some of you may not even understand what rural development is. USDA is a rural development zero down program, but it's only eligible in rural areas. We do see a lot of it out here in Livingston County, parts of Oakland, parts of Washtenaw. But rural development is going to also require 12 monthly payments after reinstatement, or if we get GUS findings, which GUS is their guaranteed underwriting system. If we get a GUS approval, then it's not required that we manually downgrade the file for an underwriting situation.
You know, and a lot of your realtors, you may know the term DU findings, desktop underwriting. Yeah, we ran it through Fannie Mae system and got an approved eligible. The GUS system is the rural development DU system. If we go through and get an automated approval, we're good to go. But if it's downgraded to a manual underwrite because of credit score or something, then we got to follow the 12-month payment history, almost very similar to FHA.
Mm-hmm.
Okay. As we go into, as we go into now, this is about rural development seasoning on refinances. So we're not going to really cover refinancing because that doesn't really pertain to you at this time. And we are going to go right into the VA guidelines. This is where it gets a little gray. But Danielle, why don't you take that slide and I'll bring them the updates we have here.
Okay. Mortgages must be current with no skipped payments, or they must be brought current through reinstatement, and they must document 12 monthly payments after a loss mitigation date.
Now, since this has been brought out, there's been some new guidelines that came out with VA because VA is designed to help the people who served our country, and they don't want to leave anybody homeless. One rule that stands out quite clearly, if you are in forbearance on a VA loan, you will not buy another home with a VA loan. You can't have two VA loans under that situation. But it gets a little sticky because VA says just because you are in forbearance doesn't mean you do not qualify for a mortgage. But this is where it's going to be pretty much lender discretion. Does it make sense? It's going to be a case-by-case basis on, you know, do they have the ability to pay, or were they just utilizing the system because they couldn't pay? So there's going to be some scrutiny here by underwriters. So I can't, or we can't give you a definite, it's this way or that way. VA has always been a little different in it. They'll do it if it makes sense, and it's going to have to make sense for the origination of the loan, like us at Highlands or any other lender like that. Anything to add to that, Danielle?
You got it covered.
Okay. So what we're going to do is just talk a little bit about an example here on loss mitigation versus a deferral here. In this real example below, the reinstatement, the first next payment date is October 1st, 2020. Based on that date, the borrower would be eligible for a new loan 3 months after the deferral loss mitigation date. Does that make sense here? Basically, if they reinstatement on their loan on October 1st, November, December, on January 1st, they would be of 2021, be eligible to do a conventional type loan. And the exception, again, is that departing residents, you're okay to proceed as long as the loan closes on the current home and you close on the new home 1 business day later. And they need a copy of the executed closing disclosure. And these are just examples here, but FHA's 12-month history. If you're October of 21, that you came out of loss mitigation, it's going to be November of 22. So 12 months there. Again, rural development, we're okay to proceed if we get that DU approval, that GUS approval, that automated approval, we're going to be okay to proceed. So that's pretty nice, and rural development is just a great loan there too. And on VA, as of September, or I'm sorry, you're going to need 12 monthly payments after the deferral or loss mitigation date. But please check with your seller's current lender if they're in a VA loan. There may be a manual type underwrite if the circumstances meet that. Correct, Danielle?
Correct. No, I'm fine.
Oh, the other left. Oh, go
Let's
ahead.
talk about jumbo loans. A jumbo loan currently is anything generally over about $549,000. Now, jumbo loans are not securitized by the normal mortgage-backed securities.
Fannie Mae and Freddie Mac.
FHA or VA or rural development. They basically are loan programs that are administered by a particular bank or lender. So what we're showing to you here is 4 different jumbo lenders that are very, very big in the jumbo market. Chase, for instance, will require 3 monthly payments made after deferral or a loss mitigation date. AIG Jumbo requires 4 years. They're basically treating it almost like a bankruptcy. Redwood and TIAA also have the same guidelines. So this would give additional caution to those higher priced properties that typically may have a borrower that would have some need for a jumbo mortgage.
You know, and this is just kind of interesting because that borrower where I messed up to ask about a second homes, he didn't make his payments because he says, look, Vic, I can make more money in the stock market doing this. And these are big high dollar houses, $700,000, $800,000 houses. So they're just doing this because they can, not understanding that if they want another jumbo and they have to use one of these investors, they're going to have to wait 4 years. So, and this borrower is saying, well, wait a minute, the government said it's okay, I don't have to make my payment. He did, but the lenders didn't say that. So, you know, it's just a shame that when we went into this CARES Act, they didn't do a little bit more justice to the consumer to say how this is really going to affect you if you do take advantage of this program.
Now, you may find borrowers that currently have, let's say, a conventional mortgage, but they're doing great, you know, they want a bigger home for their family, and but they want to buy a higher price listing and did some kind of a forbearance. This would be a huge problem.
Yep. And also we want to go back to, because a lot of times on these first-time home buyers here, a lot of times they'll use a cosigner, right? Well, that cosigner better not be in loss mitigation or loan forbearance, because that's going to be the same show. We're going to do the diligence there. And speaking about first-time home buyers, the latest data says is the average first-time home buyer is about 33 years old. And about a third of our market out there right now is first-time home buyers. So we thought we had an inventory problem. Now, on a regular sale, we have people departing a home, putting one on the inventory, but they're going to buy a home and they take one off the inventory. These first-time home buyers are going and they're plucking one out of the inventory. So the inventory is even going to get tighter from what we see. 2021 is going to be tight. What we think it's even going to be tighter in 2022.
Now, one of the things that we get questioned frequently from realtors is, do we expect to see the market bottom out again? Are we heading towards what we experienced in 2008 to 2010? When you look at the market, okay, 54% of mortgages in America are under a 4% interest rate. We have the highest property values we've seen in probably our lifetimes, really, and most homeowners have a tremendous amount of equity in their homes.
I think the average homeowner across America has about $200,000 equity.
Mm-hmm.
You know, it's just, there's an enormous amount of equity. So I think the foreclosure rates are going to be very low because people aren't going to let that equity go. They're just going to bail out and sell it.
And the government is going to do whatever they can do to prevent what we saw in 2008. Keep in mind that in the last 10 years, our residential lending has had very strict guidelines. We have to prove that our borrowers have the ability to repay. We do not have interest-only loans. We do not have stated income loans. We do not have prepayment penalties that would put a borrower in jeopardy. So ultimately, our professional opinion and some of the resources that we use on a daily basis to keep an eye on market conditions, we really don't see the market turning upside down dramatically and seeing a ton of foreclosures or seeing short sales happen again. Could you see some? Potentially. Again, watch out for those clients that maybe just bought a couple of years ago that didn't put a lot of money down. The majority, I would say, and in my client base, about 80% of my clients have not had any or very little income loss.
Yeah.
You know, there's some big corporations, for instance, GM, cut their salary workers 20% last year. They did not give raises. I don't think there were bonuses. Everybody took a 20% pay cut with the expectation that they would be paid back every dollar in 2021 at 6% interest. Okay. So the majority of people do not have, they weren't living beyond their means to begin with. If there's a 2-income household, they were able to deal with the stress of maybe a partial income loss. Certainly our service workers, restaurant workers, you know, obviously we know that that's a very difficult industry, but I also don't think that all of that population are homeowners.
You know, but the thing is with the people that this program forbearance was designed for, it's there to help these people.
Mm-hmm.
And some of these people are hurting and they are homeowners and they are in this forbearance. So we really want to do them justice by doing our diligence and asking these questions
Mm-hmm.
so we can act for our client the best. And as we talk about this recent hike in interest rates, remember what drives interest rates is inflation. If anybody remembers back, Bill Clinton in the 90s virtually had no debt. Remember, our budget was balanced, but rates were at 10.5% and 12%. Countries need debt to have low interest rates. And God knows we've got a lot of debt here in 2021, right? I think we're at $28 trillion in debt. And we're all immune to even understand what $1 trillion is. But to put this in perspective, if you were to spend $28 million a day for the next 2,700 years, 700 years before Jesus Christ came to this earth, that's how long it would take you to spend $28 trillion. And now with the new administration and new stimulus, we're going to tack on another $2 trillion there. So rates are not going to go up. We're going to see some pockets up and down, but in order to drive this economy, we need those rates to be low. So what we're seeing here in this last week is kind of just a heartbeat pulse, a spike in that, but we're going to see rates continue to be low throughout the year.
One thing to keep in mind, we've also had a lot of people go, well, house prices are going up very quickly, which we all know that they are. Do you realize though, that right now, 2020 into 2021 is more affordable than 2 years ago, even in the Detroit proper market. With interest rates this low, even if a house went up in value $30,000, the borrower has a very slight payment difference. And most people's income, their weekly average income has actually gone up. Okay.
Yeah.
Despite the stress that we're seeing with a lot of people with COVID, a lot of people have been busier than ever. Obviously real estate took a hit for 2 months while you were shut down, but we know how the rest of the year finished out.
Yeah. And as we talk about that, to kind of, I guess, recap or just kind of go over this, home affordability is at an all-time high.
Yep.
Interest rates are at an all-time low. Inventory is at an all-time low. But the potential for the market is there, so I see good times ahead of us. It's just, we got to get through this forbearance and we got to serve our clients right and give them the data and urge them to get to their lenders to make sure that it's not going to soil a listing, a sale, or we're going to leave some of our people homeless.
Mm-hmm.
We're open for questions. That's about all we have
Well,
there.
we have a ton of questions.
Uh-oh. I'm not buying
Oh,
them.
yeah.
If that's
Oh, yeah.
one of them.
So it's my job to be the question reader.
Okay.
So so that everybody who is participating knows what the question is. So I'm going to kind of jump around a little bit because I think some of these were answered in your presentation, which was extremely, extremely informative. Thank you so much. So let's start with something kind of right there that says define forbearance.
Forbearance is a forgiveness of payments or a deferral of payments. So by requesting a forbearance, and forbearance can happen on more than just a mortgage. Student loans currently are all in forbearance, anything backed by the federal government. It's just an absence of payments for a certain period of time.
Talking on that forbearance, we have several clients who have student loans, and they may work for the state of Michigan. The state of Michigan has a lot of those plans that if you work for our company for 10 years, we'll put those loans in forbearance and forgive them after 10 years. So forbearance is basically a deferment. It doesn't forgive, it forbears or delays. Does that answer?
Okay. Yeah, boy, and the questions keep coming. How can a mortgage company just put a homeowner in forbearance without them knowing it? I don't believe they can they?
They have, yes, because of the natural disaster rating.
Okay.
Or if a client called and asked about it, think of it this way.
The floods, the tornadoes.
Yes. You could have a hurricane down in Louisiana and they put the whole state in a natural disaster. So what mortgage companies do when FEMA declares the disaster is they'll just put everybody into a protective mode to protect their credit.
Okay.
So, if a client calls the servicing company, those of us that were around back in 2008 when the short sales and the foreclosures started happening, remember how painful it was to get a short sale through? What happened was that the servicing industry nationwide was not prepared for that disaster. They were also not prepared for what happened last April. And then you couple it with most states shutting down because of COVID. Everybody was working at home. You had some people not working. The mortgage companies didn't lay anybody off, but everybody went home. Our corporate office in Dallas, Texas still has everybody working at home. So the servicing industry couldn't keep up with it. So if somebody called to ask about forbearance, they click the box to protect the client and figured it would work out on the back end later.
Yeah. Here's another example to put that about how can they just put somebody in forbearance. For example, when we have a natural disaster, let's say in Louisiana, we're talking about the hurricane there. FEMA may come in and say, this is a natural disaster area. I'm sure all you agents have heard like, hey, we got a drive-by appraisal. We got an appraisal waiver. When there's a natural disaster, they're going to waive all that and require an appraisal on every property. So just to say there's a natural disaster, companies just can put them automatically in deferment. Doesn't mean you can't make your payment, but they're automatically enrolled into the deferment program. And you can continue making your payments as if nothing happened, but they won't mark it on your credit if you're late.
Okay, excellent. All right, so the next question, which gives you a little protection here by saying they know you don't have a crystal ball, but
we got tea leaves. Not the crystal ball.
Oh, better yet. Where do you believe rates will be in 6 months if the government stays in the current lockdown status? And if it doesn't and businesses are able to start opening up, where do you think the rates will be?
All national predictions, and I guess where we watch data, the Mortgage Bankers Association makes predictions. We are also members of MBS Highway, which Barry Habib, you may have heard on, he's on CNBC all the time, Fox News. He's one of the foremost nation's experts on the economy, on mortgage-backed securities.
Actually, he got the Crystal Ball Award, in the Mortgage Bankers Association. So,
he's very accurate in his predictions, but all of the predictors nationwide are going to kind of predict we hit about 3.25 by the end of the year, which we've already done right now. They do expect them to remain steady. We've heard some predictions that they could fall lower next year as we see further effects of the COVID
Yeah,
situation.
yeah,
on the
and
economy.
according to Barry's latest podcast in his seminar, he was talking about they were advising clients to, one, don't buy out of the PMI insurance, right? And possibly what the lender should be doing is raising the rates and give them a no-cost loan because they may be back next year. So we're going to see these little spikes in rates, but I'm in agreement with Danielle, 3.25 to 3 3/8 throughout the year. We may see some pockets of some under 3 and some pockets of over 3.5, but those will be short-lived. There's too much debt and inflation triggers, and there's too much scare on the economy. They can't raise rates that high.
Now, keep in mind,
Okay.
the average 30-year interest rate in America in the last 50 years is 8.5%. I'll admit I bought my first house in 1990 at 10.5% on an FHA loan for a little house my husband and I bought in Westland. And when I told my kids that, they were like, what? That's like a credit card. And guess what?
It was.
It was, but we were both paying rent and it made sense and we could afford the payment. So we did it and we haven't looked back since,
Yeah, but back then CDs were paying 16%
Yep,
too, you
yep.
know?
But
So-
we were also
That
coming
goes
off,
hand
I
in
got in
hand.
the mortgage business in 1989, when rates were about 10.5, 11%. We were refinancing people like crazy. That's when I got into the industry, was during the beginning of a refi boom that, ushered into the 90s.
Okay, we've got 57 questions waiting.
Okay, let's roll. We'll try to be quick here.
So I'm going to try to get through, I'm going to try to get through some of the ones I think are duplicates. And I want to remind everyone listening, yes, these slides are going to be made available to everyone. So this whole presentation is being recorded and Fran will have it available for everyone next week. Okay, for agents that are talking to homeowners whose home could be in forbearance, is there a timeline that they should wait before listing their home?
No, I think they need to talk to their homeowners right away, get the inclination. Are you in forbearance? Have you been in forbearance? Get with your lender immediately and understand, can we list the home now? Will you be eligible for a mortgage here in 30 to 60 days? And take advice from their current lender. Or have the agent give us a call. We'll be glad to give them advice that they can share with their lender.
Okay.
The key is getting a solid pre-approval.
Will the student loan forbearance impact a client's ability to get a mortgage? In
Well,
the same manner.
yes. Yes and no, okay? What we're having problems with the student loan forbearance is that all credit reports show $0 for payments. Now, this would be kind of a whole nother presentation, but on a conventional loan, I'll just deal with one situation. We can use whatever the credit report says for a payment, except if it says 0. So the struggle we're having right now with student loans is that we have to get our borrowers to get documentation from the Department of Education on what their minimum payments really are. Otherwise, we have to use 1%, which is too high.
And for example, we see plenty of students here come in with $100,000 in student loan debt marked as 0 payment.
Mm-hmm.
Oh, I'm on the income-based program. Well,
No,
on
you're
your
not.
credit report, it says 0. So that 1% of $100,000, we got to count a debt like $1,000 a month, just like a credit card, against them for debt to income ratios that could impact their buying power.
So
Okay.
again, is some additional headache there, and we are seeing other debts in forbearance as well. Certainly the mortgage is the most serious, but people have put credit cards in, car payments, and-
Alimony? No, I haven't
Okay.
seen that one.
No,
yet.
can't do that.
Can landlords, both residential and commercial, are they eligible for forbearance on loans? If they're
Mm-hmm.
landlords, or is it just,
Any property owner, we will have no comments on commercial because we don't know how that works. That's a completely different angle. But yes, an investor that has a mortgage on an investment property can still request forbearance if it is backed by the federal government.
And my example, my client had 2 rentals in Florida, which I failed to tell them they got to come out of forbearance in
Right.
order to move forward. And I learned hard
okay.
way.
How would homeowners who go into forbearance need to pay the payments in order to purchase a new home? I think you covered that in your slides, so maybe we just hadn't gotten to that yet.
It depends on the loan program.
Type of
Loan
mortgage,
type.
right?
Yep. Mhm.
Gotcha. And we can go back and see that. Oh, Chris, I just deleted your question. Hold on. That's not, he's not somebody whose question I should delete since he's vice president of my board. And I deleted his question. Sorry, Chris. Let me find you. Oh, shoot. Wow. Okay, here we go.
Should be back under open.
I'm sorry? Oh, you reopened it?
Yes.
I went back to dismissed. Okay. Okay, well, let me just get back on track here. Sorry.
7:31 p.m.
Prior to selling their home, can a homeowner ask for a verification of mortgage to confirm or verify that they were not erroneously placed into the forbearance program and that all payments were made and received?
Correct. The borrower can request a verification of mortgage. The mortgage company can request a verification of mortgage. One thing that we frequently do is go to the borrower because most people have online access to their mortgage and they can print off documentation that we can use faster than we can get it because the mortgage companies are, again, servicing departments are kind of working 7 days a week. So it's sometimes very hard for us to get payoffs and verification of mortgage. And we anyways get our borrowers involved because we don't want this to delay the process.
You know, one little tip there I just thought of is, you know, all the sellers or anybody for that can go to annualcreditreport.com and maybe pull a current credit report and see if their mortgage is in there. One, to check for forbearance, and two, just to check for identity theft. You know, if you're going to be making a purchase or a sale, you might want to pull your credit there just to see where you're at, to see if there's any erroneous material on there.
Okay. We have two people with a back-to-back same question. What is an overlay?
An overlay is a lender's additional guideline because they don't like whatever the agency is requiring. So, you know, a mortgage company could say, well, you know, you need 30 days worth of pay stubs after being laid off due to COVID. Another lender could say 60. So they just tighten those guidelines because they're afraid of risk. Or, you know, one of the most common things, and we do hear this from time to time, there's some lenders that won't do 5% down conventional, or they won't do 3% down conventional. Their comfort level might start with 10% down.
Yeah, here's one that most of the realtors could probably hear about is like FHA loans. You know, technically they go down to 540 on their credit scores, but a typical lender overlay, like our overlay, is we won't touch an FHA mortgage under 600 score. Some banks may say 620, some may say 640. So that's an overlay. It's just to eliminate a little bit of risk for the lenders.
Okay. How may these forbearance items affect municipal utilities or any utilities? I'm not sure I understand that question, so I hope you do.
Well, it would impact the taxes. You know, a mortgage company is going to pay the taxes whether or not the client's making their payments on time. It would not impact like water and sewer bills unless the borrower wasn't paying them and they rolled into the tax bill.
Yeah, and they became a lien on the property.
Okay.
Homeowners association dues, such as that.
When do we expect these scenarios to start hitting the market? I believe they already are they not?
I have, yeah.
Okay.
You may not have felt them as realtors yet because it's so slow this winter, but you know, you want to be prepared as our listings hopefully start picking up with our typical spring market and asking, you know, the questions to your sellers before they list the home.
You know, and I think the forbearance type listings may start picking up because people, if they're not back to work, maybe this spring, man, we got to get out. We got to do something. We're not back to work. So I think we're going to see some more of that popping up.
The good news with that is there's such a lack of inventory that we shouldn't see any price compression because of any distressed sales. You know, you should be able to market that home and get top dollar for it with your marketing strategies.
That's the good part of this.
Yeah.
Did you say no same-day closing, a minimum of 24-hour delay required? Please confirm. I think you said there had to be 24 hours in between.
On a conventional loan, if that
Right.
seller was in forbearance, he will close and make the lender whole today. By end of business day today, he cannot close on his new purchase until the next business day.
And really what we're focusing on is the type of mortgage that the client is getting on the new home. So you could have a borrower that had an FHA mortgage on their house they're selling that they were in forbearance on. And as long as they can qualify for conventional, we have a 1-day delay between closing on a home and buying a new home, no back-to-back, if they're in forbearance currently.
On any mortgage type, if they were in forbearance, you will not close on their new purchase same day. There will always be at least a one business day delay.
Okay, this is a great question. What is the impact on first-time home buyer who may have used forbearance on rental payments?
Great question.
Wow.
I thought so too.
There should
Danielle will answer this one.
there should be no impact. The majority of borrowers, we do not have to verify a rental payment history. So let's say we have a borrower, as an example, 600 or above, 680 or above credit score. We probably can get them approved. I would say, what, 95% of the time, maybe 98% of the time, we can get them approved with no rental history, as long as their income is strong and their credit's good. Where we run into problems with needing a rental history is if they have a lower credit score. So 640 or below on FHA or VA or rural development, it is going to request a rental history. I would assume, because I don't think we've run into this yet, and it's not really addressed directly in the guidelines, but if we see a low income score borrower putting very little money down and we verify a rental history, I think that would be an issue with underwriting.
That's what we call one of those lender overlays. Okay.
Yeah,
Okay.
that's a very gray area. It is not directly addressed in any of the guidelines, but that is a fabulous question.
It is a great question.
Yeah.
Okay. Will the homeowners pay interest on skip payments if they were moved to the end of the loan period?
No, there is no interest and there is no penalties. It's just thrown back on the back
Well,
of the loan.
no, I think what they're asking, Vic, is standard interest that's in the loan.
Oh, yeah.
Yes.
So
Yeah,
any interest that is
no extra interest, no additional
no
interest.
extra interest, no penalties, but any principal and interest that's delayed and added to the back of the loan will be added to the back of the loan.
Becomes part of the payoff.
Mhm.
Okay.
Whether now or in the future.
What happened to the idea of simply adding the missed payments to the end of the loan?
That is still an option. I think when they first came out with the forbearance in April, they literally threw this bill together so fast to create the economic stimulus that it really wasn't addressed. That was really a function of the mortgage industry. That's where, they had to get involved. And actually Barry Habib was instrumental in that. He actually went to Washington and said, hold up, you're going to crash the mortgage industry, which is what was occurring in March. It was actually horrific in our world. It was we were really glad real estate got shut down because it was a disaster. But Barry went to Washington and lobbied with the banks to say, we've got to come up with a system here that's going to work and not shut the banks down. So keep in mind, because everybody wants to get mad at the banks. Well, the banks have so much money. Keep in mind that in the last 15 years, the government has raised the equity stake that lenders have to have. So for every dollar we lend out in a
Capital
mortgage,
reserves.
we have to have capital reserves. So when they did this last year, that's what basically shut down, because it was turning every lender upside down. If 50% of mortgages went into forbearance in this country, the banks would have stopped
Well,
operating.
here's a good example. Let's say I borrowed $300,000 from you and I had $10,000 in forbearance. I said, hey, just throw it on the back of the loan, but you still got to make the payments to Fannie Mae.
Mhm.
And now let's throw it on the back and defer it for 27 years because I'm on a 30-year loan. You're out $10,000. How many of those can you afford to do before you go bankrupt? So
Is there a way to find out if my mortgage was flagged in forbearance without my knowledge?
that's why we say, call your mortgage, servicer, request just to talk to somebody. Hey, am I flagged for forbearance? I want to make sure I'm out of it. And also, like I said, go to annualcreditreport.com and just check that, because you need to pull that every year anyway, just to see where you're at.
Every consumer in America can pull your credit report for free from each of the bureaus if you go directly to annualcreditreport.com. You will not get your FICO score, but for instance, you could pull TransUnion, and then 6 months later, you could pull Equifax or Experian, and that's free to all consumers. So pull your credit report annually. It's a great tool. Everybody should do it. Then you can keep an eye on what's going on.
Yeah, and of course, everybody's heard of Credit Karma. I just don't know how accurate that is. And well, obviously, she don't like it. So
No, you never, ever, 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 ever give anybody your credit score without having to pay for it. You get nothing for free. I don't know Credit Karma's MO. I frankly have never played with it. The scores are not accurate, and they're not really going to give you a FICO score. It's
no, I'm
their
looking
own
for mortgage
algorithm.
history or any erroneous
Yeah,
stuff.
no,
Possible.
I wouldn't.
So
I wouldn't give your social security number away for free.
Annualcreditreport.com.
Yep.
So if the mortgage was put into forbearance and you were unaware, but you continue to make your payments, there's no effect on anything. Is that correct?
No, but if you go for a mortgage, you're going to have to call your servicing company, have them uncheck that box, take you out
Okay.
of forbearance.
Have
But
them-
as long as your payments are on time, you're not damaging any credit.
And I've seen it where even the lender may ask for a letter from that bank saying you are not in forbearance, nor you've never been there. And of course, the bank is still going to lender's still going to ask for that 12 months verification of mortgage anyway.
Now, it's important for you to know as realtors, because if your clients get frustrated with the mortgage process, please let them know that their lender is just having to keep up with all of the COVID changes. And we're not trying to beat them up, and we're not trying to be nasty with them. If you reassure them and help control the transaction, you can a lot of times calm them down, because you usually have a very personal relationship with your buyers and your sellers. So, that
Yeah,
your
we're
knowledge-
all a team. It's not us against you, against the buyer. It's the agent, the lender, and that client going to the promised land together as a team.
Mhm.
So I'm unfortunately having to skip the ones that say this. Great presentation. We appreciate all the really good news. So I want to tell you, there's a whole bunch of those in here. But I'm trying to get to the questions, but I do want you to know that there's a lot of people that are very, very appreciative of this information. Okay. I remember you said forbearance can cause you not to be able to get a mortgage if it's not cleared up. Is it possible? And I think, Vic, you gave this example that a client can be pre-approved and then denied based on the fact that they had that forbearance on their record.
Well, if you think about the credit report examples that we showed at the beginning of the presentation, a lender can miss that. We've learned a lot in 9 months since all of this started.
The hard way.
The hard way. We have not had any clients not be able to purchase a home. We have had some refinances delayed, but what if your client calls an 800 number or is doing things online and doesn't have a very experienced loan officer? We could talk for hours about examples where closings get canceled days in advance after they've been in process for weeks because somebody missed a bankruptcy in somebody's past. This is very easy for a lender to miss. So yes, you might feel stress in regards to that. So that's why if you're communicating with your client and ask them right up front, did you take advantage of the foreclosure or if you take advantage of the forbearance, were you out of work at all in the last year? Those are all things that can impact a pre-approval. And even if you just say, please talk to your loan officer directly about that situation, you may prevent deals blowing up prior to closing.
And this doesn't just go for home sellers. This goes for home buyers.
Mm-hmm.
How many times have you been in that situation where you get a lead from one of your lead sources and, oh my God, I got to get an offer in tonight. It's highest and best. It's 8:30 on a Friday night. Let's call the lender and get an approval. And the lender goes ahead and does his diligence and lacks some paperwork, and it looks good on paper, but come to find out once we get in documents that, oh, they are in forbearance on their student loans. Oh, they're not going to qualify. Oh, dad's co-signing and he's in forbearance.
Mm-hmm.
Remember, this is your reputation. This is our reputation. We need to slow down and do our homework and do the long game for success the right way.
I mean, federally, according to the government, a pre-approval does not have to give us pay stubs. A pre-approval does not have to give us W-2s, tax returns, or bank statements. You know, literally a pre-approval can just be a credit pull, looking at the scores, throwing the numbers together. Now, some of us do not do that in the course of business very frequently because we're on the street loan officers. Our reputations depend on the quality of the pre-approvals that we're giving out to our clients and our realtor partners, but not all lenders operate that way.
Yeah.
You know, if a client demands a pre-approval letter with only a credit pull, by federal law, we're obligated to give that. And for instance, our pre-approvals are very explicit. We have to answer questions before we issue the letter. Have we seen credit? Have we seen income? Have we seen assets? Do they have enough to close?
Is it in writing? Is it
in writing?
verbally?
Right.
Oh, Aiden, go on here, because a lot of realtors out there, when they're taking offers or looking and saying, hey, I need a pre-approval letter, not a pre-qualification letter, thinking that there's something different. They are one and the same, according to Fannie Mae. So it's about the realtor calling that lender. Have you verified income, assets? Is there any forbearance? That could be a question. Those are questions you can ask that lender to verify everything because it's only a piece of paper.
So really push your clients to get pre-approved before you start showing them houses. I mean, the deals that we find to be more stressful are the hit check. Okay, we gave a pre-approval out on Saturday night at 8:00 while we were at the restaurant having adult beverages and a meal.
Yeah, carrot sticks.
Yeah.
Eating carrot sticks.
Yeah, you know, so, you know, realize that if you have those rush situations that aren't thorough, you know, those could be problematic.
Okay, for the homeowners that will go into forbearance, has the process, or pardon me, that might go into foreclosure, has the process been improved to go faster and smoother than back in the 2007 recession?
Well, the foreclosure process itself is governed by the state of Michigan laws, okay? And I guess if we dust off that topic, a borrower a lender can begin foreclosure proceedings after they have missed 3 payments. Typically, we didn't see it until longer. You know, that's a great question. I would think that lenders would be better prepared. What about you, Vic? But again, I think right now with all the federal rules, because of the forbearance and the CARES Act, any of that's going to be delayed.
I think the client could actually get an attorney and put a hold on that pretty quickly until all this is sorted out.
Well, just the CARES Act prohibits foreclosures. And I also believe the state of Michigan has also put through laws. So I really don't think we're going to see many foreclosures this year at all. I think you might see distressed sellers that need to sell for multiple reasons. But again, for the lack of inventory, you're going to get that house on the market.
But to answer that question, anybody that is facing foreclosure who didn't have forbearance, it's just going to be prolonged. They're going to be able to live in the home until this whole thing starts to turn around, and then they can start, I guess, cherry picking these ones that are in foreclosure and didn't need the forbearance. And then who knows where that's going to go? That's going to be some court battles, I presume.
Okay. Will the monthly payment increase slightly if skip payments were moved to the end of the loan period?
I believe so, because they've got to rectify and balance out that escrow account.
Oh.
So the taxes and insurance are active and ongoing. Those cannot be paused. So I do believe that part of reinstatement of a mortgage, they can put the interest and the principal payments on the back end, but they're going to have to come up with a plan to balance out the escrows, get it caught up, and get the borrower moving forward with principal and interest.
Now, here's a perfect example. Here, it's almost March, but let's say in April, someone comes out of forbearance there and they reinstate it there. Well, we've got a July 1st tax bill coming up, that summer tax bill. And if we don't have enough in that escrow account to make that summer tax bill, we got to collect that up front or make up that payment while they make their April, May, and June payment. So we got enough for the July 1st payment. So
It's very complicated. If you have an escrow account, it's not just cut and dry. Because I guarantee you,
we've
the
got
cities and the
time.
townships are not gonna pause payments.
and the lender is not going to not make tax payments, because
Mhm.
if we don't make the tax payments, the township will put a lien on the property, and that becomes first lien position, which the lender will not let happen.
Okay. Is that Chris's I missed? I've only got time for a couple more. I'm trying to. Thanks, Richard. Pardon me. They're laughing at the way I field the questions. So Bob, I'm just trying to get to the ones that we have some
Oh,
that
you're
are very.
doing a great job. You're doing a great
very
job.
familiar. How does the title company deal with forbearance, i.e. in the preliminary title search? That's a good question.
I don't think they would know.
The title company is not going to know until they pull the payoff. So here's what here's the scenario. You know your seller's in forbearance and hasn't made a mortgage payment. Pull your preliminary title, but I would also get a payoff early, because unless you get the payoff, knowing how much interest is going to be added, how much negative escrow is going to be added, you can't just guess what that payoff's going to be. The only thing that pre-title is going to show is what their original mortgage balance was,
And
not
all-
what it currently is.
And also, you're going to watch for some of these FSBOs out there where you agents are getting paid, where there is no, listing agent. You're going to want to get payoff authorization to find out where that seller's position is on payoff. You could be, barking up a tree that is not going to work here. You're going to need that information to see if that FSBO guy is underwater, in forbearance, or whatever.
And any homeowner can request a payoff at any time from their mortgage lender. Ask the borrower, ask your homeowner to do it.
What are the reserve requirements today?
Reserve requirements
For a
what?
lender, I guess.
I'm not quite sure. So if you're not quite sure, then it's probably best you don't answer it and we'll move on to something else. It's
Yeah,
just
I
as what
don't-
are the reserve
mean-
requirements?
Maybe from a borrower's perspective, for getting a new mortgage, typically we want to see at least 2 months reserve in some kind of an account, but that's not always necessary. Rural development doesn't require reserve if a borrower has excellent credit.
Or a dime in the bank. Yeah, a dime in the bank or anything. Yeah.
Yeah, if you're asking about what lenders' net worth requirements are for a servicing portfolio, unfortunately, I won't know that off the top of my head.
Okay. So this one is kind of directed right at you, and I haven't given you many of those in terms of your own business. So I'm going to ask this.
Uh-oh.
Do you lend on cooperative units?
No,
There you go, Tom.
I don't know many lenders that do co-ops at all. I don't know a lender who does a co-op.
No,
I think it's a bank.
That's going to be something niche for a bank itself, because you don't actually own the entire unit. You own shares of a unit. So
Right.
typically when people call asking those questions, I say, well, the listing agent should ask the seller and the co-op management company who has financed in there, and they'll be able to give you direct information on where to send a buyer to.
And to tell you the truth, most of the questions I get on co-ops, the people end up paying cash,
Mhm.
because there's not a lot of financing opportunities out there.
Your answer to the question on reserve was answered correctly. He just said yes, that was what he was asking.
Oh.
So you did well.
Yeah.
So
I'm
it
gonna
is,
buy her
Read mine.
buy her coffee.
so it is 8:30. We do still have some questions in here, but I don't want to hold you up, and I want to let everybody, here's what we're going to do. Fran, is there a way for us to keep these questions so that we know what they are that didn't get answered?
Hey,
Yeah.
we still got time. We can
We're
answer a few more, and if people want to leave,
Okay.
they can, because you're going to record
Okay,
it.
okay,
But the answer is yes.
okay. So we'll do a few more, and then if we don't get them answered, we'll keep them. And then if we can bother you with them, we'll do that. And
Are we still holding our audience? Do we still have some participants?
226 of them.
Oh, hey, everybody.
You're doing well. So let me just say that the last two I'm looking at say this. This is great stuff. Thank you. Oh, and the one where I said, yes, you answered the question on reserve. He now said no. Here's his question. I want to know what the Federal Reserve requirements are. And she said she did not know.
Yeah, I
So
don't, I
Danielle
do
said
not
she
know
did not
that.
know
Yeah.
It's a lot more than we
Okay,
got.
a
I'll
lot.
tell
there you go,
that.
Richard. Sorry. This one says we love this session. So, I mean, great information. I'm just kind of moving them along here so I can get to other questions, but I just want you to know that there's so many people here saying that your information is great
Right.
and they're still coming. How long can forbearance last? Is there a time limit?
That's going to
It
be up
was-
to the government.
Right now, it was just extended again. So I would just say for the foreseeable future, I want to say they just extended it another 6 months.
Yeah. Originally it was 6 months and I think
Yeah,
they just
the
gave us another
student, the
6.
student loans are in forbearance till November. So I think that it will continue. And as long as the homeowner's communicating with the mortgage company, let them know what's going on, they're going to work with people.
And here's the question I'm getting for a lot of people that have student loans. Man, I don't want to start paying them back because they could, if I start paying them back, I may not have to pay them at all. The government's going to pay for all my student loan debt. So we get a lot of those questions all the time too.
Mhm.
But I recommend don't stop making any payments. Trust me, it's going to catch up one way or the other.
If you can afford to.
Yeah.
I mean, the forbearance is meant to protect homeowners. And again, those of us that have been around for a while, it's good to see that we don't have a complete shutdown of the economy. Real estate is just too huge in this country. We have to protect it and protect homeowners and help people get through a difficult time.
And the realtors
Okay.
got through, we were deemed essential.
I
I'm
had
sorry.
another question.
I'm sorry. All right.
What are the what are the current ratios? New housing payment to household income, and second is the total payment to second is total payments to household income.
Okay, 31 over 45 applies to most programs. What that means is we take total monthly income before taxes and deductions, that is divided by the new house payment is the top ratio. So 31% of that, 45 being the house payment plus all the other debt. That applies to most programs. I mean, there's a little bit of stretching we can do on some government programs. 50 is kind of a very, very high back end on a government loan, allowed in some cases.
But it all depends on the strength of the borrower too. The 3145 that Danielle was referring to is your standard run-of-the-mill type of loan, but with good credit, good reserves, good job history. On those, we can go up to 50%. On FHA, we can go up to 56% debt to income ratio. It's case by case, but again, those are lender overlays. Some lenders can't go above 45%. We can go to 50. Lenders on FHA won't go over 50. We can go to 56. And so it's all over the board. So just check with your lender.
Have you seen a 56?
Absolutely.
I've seen maybe recently 51, 52.
56.8. Approve eligible. I couldn't believe it. And I'm the lender. No.
So this isn't a question, but I still need to read it for you. These mortgage pros are a wealth of info, and I would refer any of my clients to these.
Well, thank you.
Give her the one that forbearance.
Okay.
Just kidding.
Does a
Yeah, we
business
like We like the term.
Yeah.
does a business owner's PPP forgivable impact impact mortgage approval?
Ooh,
good
it
one.
can.
Oh, yeah.
That's a good
Oh,
one.
yeah.
So I'll give you a quick story from June of last year. We had a small business owner get a $10,000 PPE loan, and it was a small enough business that the money went into her account, and she was using it to pay her federal taxes. And I told the originator, I said, I don't think underwriting is going to allow it. That is just, no, that money should not be used for personal use. But back in June, the guidelines didn't address that yet. And sure enough, by July or August, the PPE money is not looked at as a good thing. And I've seen hair salon owners have it. Actually, for self-employed borrowers, we have to get 3 months worth of business tax returns. This is agency guidelines now, to confirm that their business is open and earning income, regardless of if they were shut down or not. So that can be an issue. I had a borrower that owned a huge plumbing company in the Detroit area, And we had to subtract out the PPE money from his receivables to average his income. So the PPE money, believe it or not, it can be seen, even if it doesn't hit a personal bank account, and could impact things. We've seen people that have taken PPE loans for $250,000, $1 million. And it could potentially impact how we have to average their income right now.
You know, I've got a question for ourselves, actually. I just thought of this, is can someone use the stimulus money as a down payment or reserves?
Oh, that's a good question.
You know, Danielle, can you answer that one?
Stimulus money can be counted as an asset and used for a purchase money, similar to a tax refund.
But it can't be used as income.
Correct. It
For
is not
self-employed, okay.
income. Also, unemployment for 2020 is also not able to be averaged in your income if it was COVID related.
Oh, hold on. We got an onion peeler here because now we have several people, you know, waitresses, bartenders and that there. It says, hey, I'm back to work and I'm working 40 hours. Can I qualify for a mortgage? Can you explain how we treat that
I
income?
don't know if we have time for
Okay.
that.
Well,
But,
the
yeah.
10-cent story?
Well, it's very challenging, but no, we cannot count any of the unemployment. There are some cases where we can use unemployment for averaging income. For instance, you have a construction worker that's always laid off in January and February, and he's been doing the job for a long time. That technically we can average into his annual income. Any of the COVID unemployment cannot be averaged in for any reason. So this has caused a little strain in employees that are commissioned, hourly, bonus-based.
But even these restaurant workers who work during COVID and they're averaging only 10 or 12 hours a week, that takes down their entire yearly average, which draws their income down for qualifying purposes. So
Yeah.
it's pretty tough.
Restaurant workers probably will not be at the top of anybody's buyer list this year, unfortunately.
And just so I can probably take care of a whole bunch of these, is your contact information in the slides that you gave us?
I think
it's on the last one here. Let me double check but
All right.
continue. I'll check
If
here.
it's not, then we'll include it with
Yep.
your information when we send it out.
Actually, what I'm going to do is go ahead and share right there.
Yeah, but
You guys should be
that
saying,
doesn't have our photos
Yeah.
on it.
Okay,
No, we
perfect.
took them out.
Perfect.
but that
Perfect.
doesn't
Because
have,
I
our
have several. It
there's
doesn't
no
have-
phone number on there.
Well, my website is danielleboote.com and Victor is victorbales.com.
Okay, well, there you go. I have several people asking that. Okay, is there a government website where the consumer can access more information regarding the loan forbearance program that you're aware of?
There is, it may be what we can do is email that to you. I don't have it
Okay.
off the top of my head.
Okay, that's great. We'll include it when we send out the slides, Danielle. That would be great.
Right there.
And hey, they're even telling us it's a fun presentation. So
Oh,
my goodness, fun and informative. Is the unemployment income an overlay for your company or across the board guideline?
Across the board. Across the board. And here's what I'll tell you. I have a lot of friends in the mortgage industry all across the country. And in the last 2 weeks, I have had 2 mortgage girlfriends text me going, what is your company doing with averaging income? It's very, very tough right now. And the problem that lenders are having is that these guidelines keep changing. You know, when all of this first started back in March and April, we literally were getting emails 3 times a week from our corporate office trying to keep us updated on what was changing. Now, thank goodness it has settled down, but we're still getting a couple of clarifications every month on how that's handled. So I'll tell you, lenders are struggling, and sometimes it might be worth your borrower getting a second opinion because one lender just might be a little bit tighter than others. You know, we're very fortunate with our company. Although the company we work for is based out of Dallas, Texas, we're quite large here in Michigan, and we do have a Michigan underwriter that does help us. She does about 50% of our underwriting for our branch, but she knows the market. She's been in Detroit lending for over 30 years. So that does help us from an underwriting capacity standpoint with local knowledge of the market.
Okay, we're going to do 2 more questions. I have a client who sold their home with a conventional mortgage and were in forbearance. With the closing, they did pay off the mortgage, made the lender whole. They're currently renting and looking to purchase again this year. Will they only be able to go with a conventional loan on a new purchase?
Yes. Yeah, because that,
They have to have
all
12
the other
months.
government guidelines require a longer wait. Now, certainly we can count the rental history as payment history. But here's the funny thing. Again, we've got to look at that credit report. We've seen people in forbearance where the credit report doesn't mention it at all. And have to, again, dig into that trended data, dig into the mortgage history. So that truly is going to be case by case, but conventional in most cases is going to be the best option. And really conventional is highly dependent on credit scores most of the time. That's what picks the loan product for most people.
So while we answer this next one, Victor, would you put the slide back up with your names on it? Because people
Yes, I
are asking
will,
me for that.
and that
And
is.
we'll still answer one or two, but if you can put that up. Okay.
Yep, and your people can go to danielleboote.com or my name, victorbales.com, and contact us there. We would be happy to. We've got more literature on it, answer questions, and just help your agents build their business. That's what we do.
You have been very gracious to spend this time with us tonight. I want you to know that. All right, last question. It's not really the last question, but it's the last one we're going to ask. How could the situation arise where a seller wants to close on a property that's in forbearance one day before closing on a purchase? How did they qualify for a loan purchase on a property when they haven't reinstated their loan and are still in forbearance? I sure hope you get that.
Wait a minute. Yeah, I think I got it.
I got it.
Okay, go ahead.
Okay.
She's got it.
When we take
Good.
their mortgage application, we are, of course, going to look at income, assets, and credit. We will verify their mortgage payment history. We will see they're in forbearance. We will get any documentation regarding that forbearance. And if they're qualified for a conventional mortgage, that's where we have that one-day exception.
And we
you
will
know.
also order the payoff. So on the close and disclosure, we know that original lender is going to be made whole.
Mhm. Now, the deal needs to make sense. We have to prove that they have the ability to afford the new mortgage. Does it make sense? We have had a couple of borrowers that were in this situation and we were able to close. But again, are they buying twice the house, or are they downsizing, or are they moving closer to a new job after, a job loss because of the COVID situation? I truly think that the deal's going to have to make sense. Is it going to work for somebody that has low credit scores? No, because they won't be served well on a conventional mortgage. The rates will be too high. PMI will potentially be too high. So that is all going to be a case by case situation. It's going to require a thorough pre-approval to make sure that we vet this situation. One of the things that we do at our company is we'll send a file to underwriting if we have questions. So if we get a pre-approval with unusual circumstances, we're able to get an underwriting approval on it to make sure that we've done our due diligence and put the borrower in the best situation.
Yeah, and that goes to, again, the realtor and their lender. Slow down, do the diligence.
Mhm.
This isn't a quick thing. We got to work together, do the homework, because how we look at it, there's 3 reasons why deals blow up. Either borrowers, properties, or borrowers, because the diligence wasn't happening.
Yeah.
So again, it's the realtor and the lender having a great relationship and doing the homework up front. Play the long game, people. That's how we succeed.
Wonderful. We will take a look at the questions that were left unanswered to make sure that if they're duplicates, then hope everybody got their answer. And if they're not, perhaps we'll field those and see if we can't get some additional information for our customers.
Yeah, certainly email them to us. We'd be happy to answer them in writing so that they can be distributed to everybody.
I am very, very grateful. I'm grateful for Laura Toms at the Livingston Association of Realtors, who said, I have an idea for your next town hall meeting.
Thanks, Laura.
Yes, and this has proven to be just wonderful for our customers, and they really, really appreciate it. And I really hope you understand how much we appreciate you taking your time out of your night and doing this with us.
I want to say thank you, because it's actually nice to have the lenders and the realtors get together, because we know we all got our problems during the day. It's all reactive, but we can
Right.
actually take this time to kind of decompress a little bit and say, wow, we're all in this together, man. We are all having this, but together we shall stand and then we shall succeed. But we got to train our clients and our realtors alike so we grow better as an industry.
Yeah, and
Yeah.
spring is 3 weeks away. We got a time change coming soon, and I think it's going to be a great year. So thank you for having us. We wish everybody
Thank
a
you
great
both very much.
real
And
estate season and be very
it
busy.
is. The times they are a-changing. Oh, my goodness. And I will say that, I'm still looking at 173 people. Go to bed, people. Come on now.
Hey, there are realtors and lenders. We don't have a life. We got nothing else to do.
Time for a new day.
Vic's still drinking coffee at 9 o'clock at night.
Oh, yeah. One more.
Thank you both very, very much. I
You're
really-
welcome. Take
Bye-bye.
care.
We might need an encore. Who knows?
Okay.
So
Let us
See ya.
know. We're
Bye-bye.
happy to serve anytime.
thank you.